this morning, I'm going to try to wrap this up as quick as I can, because this subject is, and we may have to go into 2 weeks, because next week, obviously, nobody will be here. I certainly will not be here. It's Memorial Day. So, but the week after that, we'll be here. So whatever we don't finish today, we'll finish up in 2 weeks, because this is a big subject. Casey and I were just chatting. I had 2 real estate agents last week who were questioning why FHA versus conventional. Why is this person going FHA? What's the deal? And so I thought, let's take a moment and let's examine the true differences between FHA and conventional. And some of it, all of us know. But some of it also is like, okay, this is a little bit confusing. Maybe we should talk about it a little bit and get an understanding. So the first thing I want to ask is the down payment requirement. I think everybody pretty much knows the FHA down payment requirement is how much? What's that? 3.5%. That's the FHA down payment requirement. Now, I say that, there are some zero down loans. We've got a product called Home Zero for FHA, where we actually loan them the 3.5%, but 3.5% is your down payment requirement typically on FHA, unless you're doing a zero down bond program. Stay away from bond programs. They're messy. So 3.5. Anybody know what the down payment requirement is for conventional?
3%.
3%, okay. Under what circumstances?
First-time home buyer.
First-time home buyer. What's the other one? See, that's where sometimes there's confusion. Income-based, Fannie Mae and Freddie Mac have 2 products out called Home Ready and Home Possible. If you qualify for Home Ready or Home Possible, which is an income-based program, if you qualify, 3% down. So sometimes they don't have to be a first-time home buyer. They can have sold a home last year, but they still have a low income. When I say low income, you got to be 80% of the median income for that census tract. But if you're there, then you can qualify for a 3% down Fannie Mae, Freddie Mac loan. So either first-time home buyer or that. Now, first-time home buyer, let's just make sure we classify. What is a first-time home buyer?
Somebody that hasn't purchased a new home in what, 3 years, 2 years?
Somebody who has not owned a home for the last 36 months. You could have owned 5 homes in the past, but if you have not owned a home in the last 36 months, you are considered a first-time home buyer. So, first-time home buyer or Home Possible, Home Ready, 3% down versus 3.5% down. So sometimes that's going to make more sense. And you'll see a video that I'm going to post later today when I talk about the 3% down conventional. You know, one of the beauties of it is, some people may not like this, but I think it's still a benefit to that person putting down 3%. Under the new Fannie Mae, Freddie Mac guideline that went into effect beginning part of this month, you can actually get a little bit better deal than the person putting down 5, 10, 15, or even 20% because of the new pricing. So it can work out to your benefit.
You're good.
We're still good? Okay. Just making sure. All right. So that's down payment. That's first thing. Next, gift funds. What are the differences between getting a gift for FHA versus getting a gift for conventional? Are there any differences? And if there are, what might they be? First of all, can you get gift funds for both FHA and conventional?
Yes.
Yes. Perfect. Now, difference. Can you get gift funds for everything? Down payment, closing expenses, can you get gift funds for the whole thing on both products?
You can on FHA, but you cannot on conventional.
Well, you can on both within certain limitations. If you're getting gift funds on conventional, there are certain requirements that this part I want to talk about on the way those gift funds are documented, let's put it that way. Because you can get 100% gift funds for everything, down payment and closing expenses. Doesn't make any difference. In fact, I just closed a conventional loan 2 weeks ago, or a week ago Friday. And it was a $550,000 home closing in Florida, and 100% of the down payment, which was $300 and some odd thousand, was a gift from the borrower's father. Not a problem, the whole thing. So you can do that. But here's where the differences lie. If you're doing a conventional loan, it's very important. First of all, I tell my borrowers, do not accept any money from the donor until you have a binding contract. That's number one. Second part of accepting the money, you do not accept any money from a donor until you talk to me or talk to your lender. And here's why. On a conventional loan, if the donor wires the money, can't be ACH transferred, as you know, wires money directly to the attorney on a conventional loan, then the only 3 documents that in many cases, just 2 documents I have to have. But worst case scenario 3, got to have the transaction record showing the wire advice from the donor to the attorney, the wire advice from the attorney showing that it's been received from the donor, and a gift letter. Now, in many cases, I don't even need the transaction record from the donor. If the transaction record from the attorney shows the donor's name, if it shows donor's name and the amount and the account number and it matches the gift letter, I'm probably not even going to need the wire advice from the donor. But sometimes people have a tendency to act before they speak to their lender. And what do? They go and they have dad or mom write them a check for $15,000. And then they go ahead and deposit it in the account. Now I have to have the very unfriendly conversation with mom and dad that now I have to have a full bank statement. And mom and dad typically don't want to give me that bank statement. And so we'll go back and forth a little bit, and then I simply have to tell mom and dad, look, it's very simple. They can either use the gift funds or not. In order to use them, I got to have that. It's not my rule. It's not my company's rule. It's a Fannie Mae, Freddie Mac rule. So please tell your borrowers if they're getting any kind of gift funds, always, number 1, do not do anything until after you have a binding contract. And number 2, speak to your lender so it's done the right way. Now, FHA is just a tad different. FHA does have a rule that says the lender must look at the statement, even though I'm going to have them wire the money directly to the attorney, same as I do conventional. FHA does say that we have to show that the donor has the ability to give the money, which simply means I'm going to need a bank statement. That'll show they need the money. Now, every once in a while, you can get around it a little bit by getting a transaction record that shows the account number, the person's name, the bank, and it shows the amount that was in the account before the transfer and after a transfer, rather than getting a full bank statement. So sometimes you can do that. But again, same thing. Yes, Casey?
Can you use gift funds to cover 100% of the down and closing costs for FHA?
Both. FHA and conventional, 100%.
Okay.
All right. Jay?
Does it have to be from a personal, the donor account?
Thank you. That was going to be it has to come from one of 2 places. It either has to come from a blood relative, brother, sister, mom, dad, aunt, uncle, son, daughter, cousin, uncle. Now, different last names and it's more further removed, we've got to get documentation. The lender has to get documentation to show that. But yes, typically blood relative. The other place they can get gift funds from, charitable organization. What type of charitable organization? I always give the example, you can get it from your church. That doesn't happen often, but you could potentially get it from your church.
If dad writes a check to their kid.
What's that?
If dad writes a check to the kid for down payment, they deposit in the bank, is there still a seasoning requirement?
No. Now I just have to document that one full bank statement from dad.
There's no seasoning any longer?
No.
Okay.
No. Now, seasoning only goes into play if I don't want to say it's gift funds. But if I'm saying gift funds, that's just, we can do it the day of. It works out really well. Again, if you just don't do anything until you have a binding contract and then talk to your lender and make sure you do. If you do it that way, never have a problem. Okay? All right. Credit. There are some differences on credit scores. So, any idea what the low credit score is for a conventional loan? Most lenders like us are 640. Most lenders like us are 640. Fannie Mae, Freddie Mac say you can go to 620. We stop at 640. My underwriting manager will say, Greg, we will go down to 620. Yeah, we're not going down to 620, trust me, it gets too messy. So 640 is typically the cutoff. And besides, if you go down to if you've got a 641 credit score and you're doing a conventional loan, there's got to be some weird reason why you're doing that, because you are going to pay dearly for that interest rate and discount points.
So getting approved eligible on somebody with a lower score with loans that have a lot of assets? Used to get approved eligibles all the time with people at 610.
Oh, we can't go below 620 on conventional. Can't. You won't, I mean, just can't go below 620. Now, FHA, you can go, how far down on FHA? 580. Interestingly enough, thanks, Chris. Interestingly enough, actually, FHA doesn't really have one. They leave it up to the lender. Now, most lenders will stop at some number, 620, 610, 600, 580, whatever. I don't do them below 600. And part of the reason why is it is so messy. You start going below 600, first of all, you oftentimes don't even get an approved eligible, as Chris was mentioning, you don't, which means you then have to do some manual work to it. There's also other restrictions. You can't have any late payments in the last 6 months of any kind. And if somebody's got a 580 credit score, 585 credit score, guess what? They probably have a bit of an issue there. So my guideline, 640, 600, and then we can go forward. But let's take that one step further. Once you go below 700 on credit scores, you're generally going to find better pricing opportunity and better PMI numbers and overall better payment with an FHA loan. So bear that in mind. 680 definitely, below 680 definitely, probably FHA. Doesn't have to be, but probably. So those are some differences when you're looking at credit scores. Any questions before I go? We're doing pretty good on time. Debt to income, before I do debt to income, PMI and MIP. PMI is conventional. FHA, we always say PMI, but it's actually MIP, mortgage insurance premium. What's the single biggest difference between conventional, PMI, and FHA, MIP? It's the single biggest difference.
The FHA went down.
I'm sorry?
The FHA went down.
FHA did go down, but what's the biggest difference?
It never goes away.
No, it does go away now. That was part of the change when they lowered it.
Oh, really?
Single biggest difference. PMI does not have any upfront cost. MIP, every FHA loan, I don't care how much money you're putting down, it's going to cost 1.75% upfront. Now, the borrower doesn't write a check for that. The lender simply adds it into the base loan amount. So you put down 3.5%, and HUD goes around and says, we're going to add 1.75, half of your down payment. We're going to add it to your loan. Now you have a new base, you have a total loan amount. So 1.75, that's a big number. But again, sometimes you just don't have any choice. But please remember that number, 1.75%, that's up front. When you do your financing exhibit, you got to fill it in. I think it's on page 2 if I'm not mistaken. You got to fill it in there. 1.75% going to be financed. No way around it. We have a loan closing this week, Thursday, and 600 and I think the sales price $675,000. Maximum loan amount I can do is $590 for this market. And so they're putting down, think about that, they're putting down $70-some odd thousand on this thing, and they got to pay 1.75%. It's an FHA loan. So anyway, so any questions on PMI, MIP? All right, now the big one, debt to income ratio. What is the difference, the biggest difference between debt to income ratio for conventional versus FHA?
In conventional, like 36%, and FHA is 43%.
Well, okay, good point. Here, let me, as you know, there's always two ratios, housing debt to income, total debt to income. Let's go to total debt to income, because that's where the numbers get really, if you've got a decent credit score on conventional, you can go all the way to 49.9%. If you've got a decent FHA, when I say decent, 680, 685, 690, even 660, you can, as long as your housing debt to income ratio is low enough, you can go all the way to 55, 54, 55, maybe even 56% debt to income ratio. So sometimes the only way to make a loan work, even if it's a 700 credit score, is to go FHA, because I can go all the way to 55 or 56%.
But that takes pretty hefty compensating factors a lot of times, right?
Believe it or
not, doing them to 55, but there were a lot of compensating factors.
well, Jeff, I think there's got to be some. I think the biggest compensating factor is that the housing debt to income can't be 48%. Housing debt to income is going to probably have to be below 43, maybe even below 40, depending on the credit score. If you have a low credit score, when I say low, say you're down at 630 and your DTI is coming in at 55, that may not fly. So credit score, all of that's affected, but the biggest single difference, just remember this, you can go over 50 on FHA, you cannot go over 50 on that back end, the total DTI, on a conventional. That's the single biggest difference. And sometimes, if I've got a 665 credit score and they've got a 48% back end ratio, I can't get it approved conventional. To Jeff's point, I don't have enough compensating factors. I don't have enough reserves in there. I don't have something in there that's not working. Now I have to take it FHA, because FHA will almost always fly through at 48%, especially if I'm above a 640 credit score. So those are big differences why we would do that. Make sense? Now the last one. Oh good, we're going to get through it. Appraisal. What is the single biggest difference between doing an FHA contract and doing a conventional contract on the appraisal?
The appraisal on FHA stays with the property.
That's one, stays with the property for 120 days from the issuing of the case number. What's number two?
The mandatory clause.
The amendatory clause. All right, on a conventional financing exhibit, on page 1, you actually put in there how many days they have for an appraisal contingency. That's on conventional. On FHA, there is no time frame. The amendatory clause on page 2, number 12, states, or you put in there the sales price. And regardless of when that appraisal comes in, as long as it meets that sales price, the appraisal is good, assuming that there's no issues on the file itself. But if it doesn't, then the buyer doesn't have to buy the house. And you've heard me say this before. And real estate companies, brokers, even some attorneys will disagree with me. And they'll say, you can put a clause in there, that'll be an escalation clause, and buyer agrees that they're going to pay more and more, do this if it comes in too low and all that. You know, no.
Fight the government.
You can't, thank you. You're not going to beat HUD. You're not, I don't care what you put in special stipulations, you're not going to beat HUD. HUD rules the roost. So that stuff there is, kind of makes it feel good. So how do you beat it? I mentioned this a couple months ago when we did FHA appraisals, but this is important. If you're writing an FHA appraisal and the listing agent is nervous, the listing agent says, no, 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 I don't want to do FHA. I don't want to wait forever to get the appraisal in. Here's how you combat it. Speak to the borrower. How convinced are you want this property? Borrower says to you, I'm going to get this property. This is going to be my house. There is no doubt. And I said, what about your inspection? I'm having an inspection done the day after we're binding. So I can order that, right, I can order it the next day. So within 48 hours of binding contract. That's what we tell the listing agent. And what I do, if it's my buyer, I get on the phone with the listing agent. And I tell the listing agent, I say, look, Casey's just presented this offer. You don't have to worry. We're getting our appraisals back in 7 to 8 days, maybe 10 at the very most. And the buyer has agreed, we're going to order that appraisal within 48 hours of binding contract. So it's going to be as good or better than getting that conventional appraisal in here on time. How do you feel about that, Mr. or Miss Listing Agent? Oh, well, that makes it a lot easier if I can do that. That's the point. So now we can combat that whole contingency thing because it's really on time. The appraisal's the appraisal's the appraisal. I mean, whether it's conventional or FHA, still got to have all the right comps, still got to have all that stuff, but it's just that there's a difference in timing. Yes?
Just because a STIP is not enforceable doesn't mean it's not a good STIP. And what I mean is sometimes I'll write into an FHA contract, all parties acknowledge and agree that the appraisal shall be back within 14 days or however long before. Do I know that the amendatory clause is going to override that? Yeah, but also it gives the listing agent something in writing from us that they can, that's part of the contract.
Yep. Either that, Casey, or just put in there, we're ordering it within 48 hours.
Yeah.
Either way, but again, the important thing is, in my opinion, is get the lender involved. If it's me, you know I'm going to be involved. Get the lender involved to make the call to the listing agent, give them the strength that they need so that they can say, hey, this is going to go FHA and we're going to be okay. The last thing I want to mention about FHA is the site visit. Now, people will oftentimes say, I hear it from agents all the time, I don't want to do FHA because they're just going to nickel and dime, they're going to pick this thing apart and they're going to go after everything that's wrong with the house, blah, blah, blah. Okay, first of all, they're looking for health or safety concerns. Now, FHA does have a whole long list of what those things are, but they're looking for health or safety concerns. And trust me, if it's a health or safety concern on an FHA, it's possibly that it's going to be a health or safety concern on a conventional loan. Now, conventional, two different issues that'll happen with the appraiser. Some appraisers will take the stand. It's not their call to say that it's a health or safety concern, unless it's serious foundation issue and the house is going to fall down. They may see a hole in the wall and they may end up leaving it. They'll leave it as is. And on a conventional, they can do that. FHA, they can't do that. But here's what happens. They leave it and the picture shows that there's a hole this big in the wall behind the sink. And they don't put it subject to on a conventional. Well, that doesn't mean it's okay, because when underwriting sees it, because underwriting is the final say-so, not the appraiser. Underwriting looks at that great big hole and says, wait a minute once, that creates a potential health or safety hazard. We want it repaired before. Now all of a sudden you got an appraiser that says as is, and the conventional underwriter looks at it and says, I want that repaired. So bear in mind, just because a conventional appraiser takes the stand, I don't need this done for my value, the underwriter, whose main concern is for the borrower, they're going to look at it and they may end up saying, which they oftentimes do, that's got to be repaired before. So there's just not a huge difference in the appraisal if you structure things right, as Casey mentioned or as I mentioned. Oh my gosh, we got done 24 minutes, 9 minutes over. Any questions? All right, thanks.